The economy is booming. But does it feel that way in your life? Your paycheck, your local stores, your opportunities? Something doesn't add up. Stock markets near record highs. Corporate profits rising. Headline numbers look impressive. But beneath the surface, a different story is unfolding. There's something strange about how money's flowing right now. This is America at the beginning of 2026, and the economy is more divided than it appears. By late 2025, economic growth surprised analysts. Recession fears faded. Inflation cooled. Financial markets rallied. But economists noticed something else. Growth wasn't evenly distributed. The economy split into two very different realities. A classic K-shaped recovery. Some groups move up, others fall behind. This divide isn't just about output. It shows up in wealth, in income, and in opportunity. Households tied to assets like stocks and real estate saw gains. Those relying on wages alone felt pressure. The gap keeps widening. The same split is now visible across businesses. Large corporations thrive. Small firms struggle, especially those dependent on everyday consumers. And this contrast is reshaping the U.S. economy. At the top, major corporations had a strong year. Technology firms led the way. Artificial intelligence drove investment. Automation boosted productivity. And market optimism followed. Shareholder value surged, measured not in millions, but in trillions. There are clear reasons. Large companies have scale. They access cheap capital. They borrow at lower costs. They lock in long-term contracts. They diversify risk. And they can absorb shocks that would cripple smaller firms. Small businesses live in a different economy. These are firms with limited staff, tight margins, and little room for error. By late 2025, many owners stopped expanding. Hiring slowed. Replacement hiring stopped. Some quietly reduced hours instead of laying people off. On paper, unemployment stayed relatively low. But beneath that, a softer labor market emerged. Fewer new jobs, fewer openings, more underemployment. People still counted as employed but earning less. That gap matters. This isn't a niche problem. Small businesses employ nearly half of the U.S. workforce. They generate over 40% of economic output. When they slow down, the entire economy feels it. Even if stock charts don't. So what's driving the strain? Economists point to several overlapping forces. First, costs. Input prices remain elevated. Rent, insurance, utilities, financing. Large firms spread these costs. Small firms absorb them. Margins shrink fast. Trade policy added uncertainty. Tariffs raised import costs. Supply chains became harder to predict. Large corporations adjusted. Smaller firms had fewer options. Price volatility increased. Planning became harder. The labor market added another challenge. Hiring slowed sharply in 2025. Available workers became harder to find, especially in service industries. Turnover stayed high. Training costs rose. Productivity suffered. To keep staff, wages climbed. That's good for workers. But for small firms, it cuts directly into profits. Hiring fewer people became the only option. Expansion plans were shelved. At the same time, consumers changed. Households became cautious. Discretionary spending slowed. People traded down. Cheaper options, shorter outings, smaller purchases. This hit local businesses first: restaurants, retail, events, personal services. Industries built on volume and foot traffic. Bookings softened. Average spending declined. Margins narrowed further. As conditions tighten, confidence erodes. Owners delay decisions. Investment pauses. Hiring freezes. That caution feeds itself. Uncertainty becomes the norm. By early 2026, the picture is clear. One economy driven by capital markets, technology, and scale. Another driven by wages, local demand, and tight margins. They coexist, but they move differently. Here's the risk. Household consumption drives about 70% of U.S. GDP. If income growth stalls for millions of workers, spending slows. That eventually reaches even the strongest companies. The long-term trend is forming. Market consolidation. Big firms gain share. Small firms adapt, merge, or disappear. Efficiency rises. Resilience falls. Artificial intelligence accelerates this shift. Automation reduces labor needs. Costs fall. Output rises. But transitions are uneven. Not everyone adapts at the same speed. That leads to a deeper question. If fewer people earn stable incomes, who consumes? Who supports demand? And how does an economy function when growth outpaces purchasing power? The U.S. economy is not collapsing, but it is fragmenting. Understanding that divide may be the key to navigating the next economic era. Money is behaving strangely. Markets look strong. Headlines shine. But if you look closer, something feels off. Profits rise, yet wages barely budge. Productivity grows, but more people feel left behind. Money flows upward. People stay put. The economy moves, but only for some. Small businesses struggle. Families tighten budgets. Dreams are postponed. And the strangest part? Life feels normal until the numbers hit your reality. This isn't failure. It's not laziness. It's the system quietly shaping who wins, who loses, and who just watches. Some thrive automatically. Others scramble to keep up. Money, once a tool, now tests patience, resilience, and attention. It's easy to miss until the bills pile up, savings stay flat, or opportunity passes by. And in that moment, you realize the economy can grow, and you can still feel stuck. That's the strange side of money. Not because it's gone, not because you did something wrong, but because the system moves faster than most of us can.